Welcome everyone. My name is Gracjan Bachulewicz, and I am a PhD student at the University of Warsaw. And this guest lecture is a part of the central banking seminar that I am coordinating in this semester. So I'm very grateful that Louis-Philippe has accepted my invitation to this seminar to deliver a lecture on the future of central banking, which is really interesting, and Louis-Philippe for sure will provide us some insights into the future of central banking on different levels. So let me just shortly introduce our guest, our speaker, and just remember to stay muted. The lecture will last about 45 minutes, and after that we will have 45 minutes as well Q&A session in which you can ask questions by raising your hand. So, but also you can write your question in the chat. All right, so just let me begin with introducing Louis-Philippe Rochon, who is a professor of economics at Laurentian University in Canada, where he has been teaching since 1994. He obtained his PhD degree from the New School for Social Research in 1998. Earning him the Frieda Wunderlich Award for his dissertation, and was on endogenous money and post-Keynesian economics, so very interesting. And now Louis-Philippe, since 2019, is the editor of the Review of Political Economy. As some of you may know, he's also the founder and now the editor emeritus of the Review of Keynesian Economics. Louis-Philippe is also a member of our scientific council of the Edward Lipinski Foundation. So also some of you may know it, that the foundation is a young organization which was established a year ago, and also I'm a part of this foundations. And our aim is to promote pluralism in economics. So that's what we do. And hopefully we can have such nice guests as Louis-Philippe in the future, and do some interesting conferences and seminars in the future. Louis-Philippe is also on the editorial board of many economic journals, including International Journal of Political Economy and the European Journal of Economics and Economic Policies. Louis-Philippe is the author of many books, more than 100 books and papers, and in peer-reviewed journals. His forthcoming books include The Future of Central Banking, a short history of economic thought, Employment in the Age of Austerity, so very interesting titles, and a 2-volume book honoring the work of Marc Lavoie and Mario Saccareccia. So as you can see, Professor Rochon is really the perfect match, the perfect guest today. So please welcome Louis-Philippe. The floor is yours.
Well,
share your slide also with us.
Yes, I will. Thank you very much for that warm introduction. I want to say good morning, good afternoon, and good evening to everyone. Thank you for joining, and wherever you are from around the world, I hope you are well and you are keeping safe. I want to give a shout out to one of my students who got up this early to come and listen to her professor. So hello and good morning to Gail. As well, Sunanda from India, and people from Canada, Germany, Italy, Germany, and more. So thank you very much. And I do want to say to the students, I was earlier wearing my sweatshirt from the University of Warsaw. And if you remember, Gretchen, you were with me when I purchased it.
Yeah, yeah, yeah.
But
That
it's a bit too warm in my office. So
okay.
okay, so I'm going to share my files. And I'll begin the presentation. First of all, just the picture on this first file is a picture I took of the Museum of the History of Polish Jews in Warsaw. It's a great museum, a great building. And I was honored to, that was when, I think it was last October when I was in Warsaw. If you remember, Graczyna was presenting at the central bank there. And I had a great stay. Let me see, how do I, okay. So this is, I am the editor-in-chief of the Review of Political Economy. This is the new cover of the journal. And it's a journal that was published, that was started in 1989 by John Phoebe. And it's got a great history of some amazing papers in heterodox and post-Keynesian economics and some in Marxist thought as well, Schumpeterian, etc. So it's a journal that's the first journal in which I published my first paper, in fact. So it's sort of coming back full circle to it. The talk today on the future of central banking is based on a book series that I am currently doing for Edward Elgar called the Elgar Series on Central Banking and Monetary Policy. And this is a series of 10 books that will be coming out in the next 3 or 4 years on various subjects. And the idea was born out of a conference I hosted in Terroir, France last year, and called The Future of Central Banking. I think that was the name of the conference. And these 10 books will be on different aspects of a monetary policy and central banking. And different books will deal with, for example, the relationship between central banking, monetary policy, and income distribution, which I will have a few things to say about at the end of the slide, but also on social responsibility and democracy, and I'll have something to say about that, on the environment, on gender, on the future of money, bitcoins, electronic money. There'll be a book on financial stability, one on the future of monetary policy. How will that look in the future? The implementation of monetary policy. And finally, the conduct of monetary policy in developing countries. So these 10 books, and the series is open to more as we progress, will be sort of the first series of its kind, really, from a heterodox, critical, or post-Keynesian perspective. And we're very excited to be dealing with issues of gender and ecology and the like. And I also want to say that I'm in the process of creating an institute right now called the Monetary Policy Project. This is its landing page, which is not up yet. But essentially, the Monetary Policy Project will be a virtual sort of institute think tank that will address many of the issues that I've just mentioned. But also there'll be other projects, parallel projects, such as right now I'm putting together a project on monetary policy and asset inflation. And there'll be one on gender, of course, and there's one on fiscal policy multipliers and the relationship with monetary policy. So there'll be quite a lot of projects and publications and conferences and workshops within this project. So for introduction. Well, while this talk is about the future of central banking, you can't really speak of the future without first speaking about the past. And one of the things I want to do in here is to present the mainstream monetary policy model and deconstruct it and show how the model itself has become irrelevant. And in being irrelevant, that opens up the field to all sorts of questions. What does if monetary policy does not do what it's supposed to be doing, what's the purpose of monetary policy? What's the nature of monetary policy? And what's the relationship, or what's the transmission mechanism of monetary policy and the real economy? So I'll be first deconstructing the model and then trying to reconstruct the model from a post-Keynesian perspective. And from the rebuilding it from a post-Keynesian perspective, one of the three things that I'll be talking about is whether monetary policy is class biased, whether monetary policy is gender biased, and whether it is carbon biased. And these questions are not dealt with from the perspective of the mainstream. They're a little bit, certainly the environmental aspect, but it is dealt with in a very different way. So I'll be raising these questions at the very end. And linked to this question is the role of an institution that if we can show that there are these inherent biases in monetary policy, how then do we link this, or how do we link the concept of an independent institution with the notion of democracy? Are these institutions democratic? So I'll be dealing with these at the very end. So it is somewhat ironic that as a specialist on monetary policy, it's ironic that I've become somewhat disillusioned with monetary policy, and especially monetary policy as it is used today in terms of fine-tuning, right? Fine-tuning for the young students who are here today. If you don't know what fine-tuning is, maybe you remember a radio in your grandparents' house, and where the radio has a big knob, and you turn the knob a little bit to the left, a little bit to the right, in order to get the frequency just right. And this is what monetary policy does today. It raises interest rates a little bit. It brings it down a little bit, just until it gets it just right. And what that right is, I'll explain in a few moments, of course. But that's what fine-tuning is, and that's what monetary policy has been designed to do. But as I will argue, that's sort of a fruitless approach to monetary policy. And I think there's an openness, a very limited openness within central banks in discussing these limitations. And I think now more than ever with the coronavirus, we see the degree to which monetary policy is limited. And like I said, I think there's certainly in Canada, there's discussions about changing the mandate. New Zealand has done so, and I'll address this later. But I think people are sort of aware of the growing ineffectiveness of monetary policy. And so speaking about ineffectiveness, so this is measured in terms of, or in relation to, the central bank's goal of inflation targeting, where the central bank targets a rate of inflation and uses the interest rate to fine-tune economic activity until they hit an inflation target. And it's in that sense that I mean it's ineffective. It is effective in other ways, and for me, I'll explain that later. But I have a forthcoming paper on that topic called "The General Ineffectiveness of Monetary Policy," and the word "general," of course, in reference to Keynes. So I'll be talking about the pre-COVID monetary policy, right, as if COVID has now become sort of a benchmark reference to many things to come. So the pre-COVID, and then I'll have a little bit to say about COVID, monetary policy during COVID, and especially with respect to quantitative easing. And I'll end with reference to the future of monetary policy, or what it should be post-COVID. So the pre-COVID monetary policy, it's known as the New Consensus Model, or the Woodford Model, or the Taylor Model. Call it what you want. It is a very elegant model, very simple, 3 equations, and where the overall objective of monetary policy is to hit an inflation target, usually around averaging 2%, or a corridor of between, let's say, 1 and 3. And that's called the inflation target. And then the equations, you have an IS curve, a Phillips curve, and a Taylor rule. And I'll come back to these equations in just a little while, but I do want to say something about the 2% inflation target. Benjamin Friedman, who's a professor at Harvard, not to be confused with Milton Friedman from Chicago, but Ben Friedman had a great quote, and I'm just thinking about it now, and I should have put it in the slide. But he says something that, like, to the effect that it's really incredible the paucity of research, meaning the lack of research at the time about choosing 2% as an inflation target. There was really nothing in terms of credible research supporting a target of 2%. Why 2? Why not 3? Why not 4, 5? So the target of 2% was really chosen quite arbitrarily. And as I tell my students all the time, everything in economics is an empirical question. But, that's in theory. In practice, that's not the case. And this is a good example of a lack of empirical support for something that is so crucial to economic policy. Because in an inflation targeting regime, if inflation is close to the upper bound or close to 2% or a little bit over, the central bank kicks into restrictive policies and start raising interest rates. And that may end up having some negative consequences. Whereas if the inflation target was 3% or 4% or 5%, interest rates would not start going up until inflation reaches 4%, for example. So you can see that it's such an important central bank reaction function that the target, the numerical target itself, is quite important. So why 2%? We don't know. And that's, quite unfortunate with possible consequences. So the pre-COVID policy is sort of a leftover of monetarism. You still have within central bank thinking, or the central bank view, a vertical long-run Phillips curve, right? So there still is belief in this natural rate of unemployment, which is structurally determined by your supply side of your model, your real variables. Granted, that natural rate may be a moving target, but there's still a belief in that value. There's certainly the idea that growth is largely determined by supply side considerations. There is a fundamental belief in a natural Vixelian rate of interest. There is a fundamental belief about crowding out effects, where fiscal policy, increases in fiscal policy lead to increases in the rate of interest, which then, of course, lead to decreases in investment. So public sector expenditures lead to private sector expenditure declines. And fundamentally, there's always this belief that if inflation is not always and everywhere a monetary policy phenomenon, it is always and everywhere a monetary policy phenomenon, to paraphrase Friedman. And that's why central banks are made to be the guardian of inflation. Inflation is not the purview of fiscal policy. It is left entirely within the objective of the work of central banks. And because it's precisely for the reason that inflation is still seen as largely a result of aggregate demand, but of monetary policy through its mechanisms. But despite the fact that the mainstream has adopted a Taylor rule, which is an interest rate rule, it's still very much old wine in a new bottle, which is a great quote by Marc Lavoie in a paper I published in one of my books. But nothing else has changed. I remember when I was doing my PhD and I was writing my dissertation, and I wrote a paper, I wrote an email to Benjamin Friedman, and he had published. So in the last chapter of my book, there's this discussion about how the mainstream has seemingly adopted some post-Keynesian features. And Ilan Dogus, who's here today, and I have been discussing for a few years, but we never got around to doing a paper precisely on how the mainstream has adopted many of these features and more. But I was the first one to talk about this topic back in, my book was 1999, I think. And I wrote to Friedman, and I said to him, I said, wow, you guys are talking about interest rates and that has consequences. And he wrote back saying, no, he says, it's the same old thing. Nothing has changed. We just replaced money growth targeting with an interest rate target. And for me, that quote was very revealing in the sense that the mainstream was very much still thinking in terms of these types of arguments. Nothing's changed. And this is why Lavoie has said it was old wine in a new bottle. Now, inflation targeting, however, is seen as a superior policy because it sort of makes a central bank more transparent. So before, when you had monetary targeting, the central bank was not going around saying, monetary M1 or M2 is growing at 2%, 3%, 4%. But now we do know what monetary policy is. It's an interest rate of 1%, or in this case, almost lower bound 0%. And so monetary policy is more transparent. And it is said that household or private sector expectations are anchored. Inflationary expectations are anchored, and that has consequences that it makes for less output variability in the long run. And so here's a quote by former governor of the central bank, Janet Yellen, who's now the new Treasury Secretary. But the relationship, and so I'm sorry. So inflation targeting has been credited. Now, inflation targeting was adopted in New Zealand in 1990, I believe, 91 in Canada, and it's been argued that inflation targeting is responsible for low inflation today. In fact, we can say that in many countries of the world, Canada, US, Europe, inflation is not a problem, and it has not been a problem for the last 30 years. It's hovered more or less around a steady trend of 2%. And this has been used as an argument in favor of the success of inflation targeting. But to say that inflation targeting is responsible for lowering inflation from the very highs of the 1990s is not very true, because as few papers have noted, inflation in the early 90s was already on the way down before inflation targeting was adopted. Now, this may be because central banks were unofficially inflation targeting, and that perhaps, but I'll have something to say at the end about why that is, and why specifically is inflation not much of a problem today. So, like I said, this new consensus model is this very elegant three equation model, an IS curve, which captures the negative relationship between interest rates and aggregate demand, investment, consumption. Then the Phillips curve, which is a negative relationship between unemployment and inflation, or a positive relationship between output and inflation. And then a Taylor rule, or what Romer has called a monetary policy curve in his paper Keynesian Macroeconomics Without the LM Curve in 2000, a very important paper. And the Taylor rule is simply an interest rate function where the central bank sets the real rate of interest according to that should be Vixelian, not a Wicklian natural rate, a Vixelian natural rate plus some sort of inflation gap and an output gap with different weights attributed to inflation gap and the output gap. And essentially, if the weight for an output gap is traditionally much lower than the weight on the inflation gap, and so if inflation is seen to be pushing up against the upper inflation bound corridor, then interest rates tend to go up. And this increased interest rates feeds through the IS curve equation 1 to bring down investment and consumption and aggregate demand, which through equation 2 brings down the inflation rate in the hope that inflation will eventually soft land to the target. And so where the proponents of this model agree is that hard landings ought to be avoided. So soft landing is more desirable. And a hard landing is when the economy simply collapses, right? So what the central banks want to do is to have an interest rate policy where it raises interest rates and aggregate demand and inflation slowly comes down with very minimum negative consequences on output and employment, right? So this is a soft landing. But the problem with this model, and for reasons I'll explain in the coming slides, is that monetary policy is never about increasing interest rates once or twice. If you look at the pattern, central banks usually increase interest rates 10, 12 times, right? The purpose or the aim is to get to your natural rate of interest. And right now, if central banks increase interest rates by about 25 basis points at a time, interest rates in the US are zero. And if the natural rate, well, we can't calculate the natural rate, of course, but central banks insist on you can. And the natural rate is about 3 or 3.5%. And if that's the case, central banks would have to increase interest rates 14 times to bring it up to the natural rate, or what now is called the neutral rate, which is ironic because the pursuit of a natural rate of interest, there's nothing neutral about it. It just ends up collapsing your economy. So I'm not sure why they're calling it neutral at all, but there you go. Now, the success of inflation targeting depends on the transmission mechanism, okay? If, equation 1 and equation 2. Those are your transmission mechanisms. It's a two-step approach. And the impact on aggregate demand should be predictable, and so should be the impact on inflation through the Phillips curve. So identifying the Phillips curve is important. And the IS curve has to be well behaved. And it has to be somewhat elastic. Because if you have an inelastic Phillips curve, you may not be able to bring your output, to raise your output to the desirable level. So you have to have a respectable or an empirically relevant interest sensitivity of investment and consumption. So and so there's many sort of mechanisms, and they all deal with the demand side of the equation. But what can we say about this transmission mechanism? Well, the first equation is on the IS curve, the interest sensitivity of investment. Well, we know, especially from the work of Stephen Fazzari at the University of Washington in the United States, that the value of the interest sensitivity of investment, and for Gale, that's the coefficient B in the investment function in class, is not very high. Investments and consumption don't respond very well to interest rates, or at least to incremental changes in interest rates. Of course, if you raise your interest rate 14 times, you're going to get that reaction that you're looking for. So you can imagine some sort of a kinked IS curve where it's very inelastic at lower interest rates, but eventually becomes very elastic at higher rates. And where that kink is exactly, I don't know, but certainly closer to your natural rate. And so, yeah, so that's why I've described monetary policy, and that's why I've grown rather disillusioned with it. It's sort of a sledgehammer. It's like you have a fly on a table and you want to kill your fly, but instead of using a swatter, you use a hedge hammer, those big hammers, sledgehammer, and you'll kill your fly, but you're going to completely destroy your table. And that's sort of what inflation and the economy is. You want to kill your inflation, but you end up destroying your economy. So it's a very blunt instrument. This quote by Barry Cinnamon and Stephen Fazzari, and of course Mark Setterfield, one of my co-authors, is a good illustration of this. The transmission mechanism for monetary policy to aggregate spending in new consensus models, which is your equation 1, relies on the interest sensitivity of consumption. It is difficult, however, to find empirical evidence that households do indeed raise or lower consumption by a significant amount when interest rates change. And some authors have generalized the link to include business investments as well. But a robust interest sensitivity of investment has also been difficult to demonstrate empirically, right? Everything's an empirical question. So there you go. And for the record, it's not just heterodox people who say that. In fact, Stephen Fazzari is a new Keynesian, but so not exactly heterodox, but certainly has a foot in each camp. But look at Bernanke, the former governor of the central bank. He's saying, well, you know, so he's saying interest rates may have an impact, but there are other variables that may impact inflation, investment, cash flow, leverage, balance sheet factors. You know, he hasn't mentioned expectations of aggregate demand, uncertainty, capacity utilization rates. But the essence of his quote is that there are other factors in that investment function. And look at this new Federal Reserve Bank of New York paper by Sharpe and Suarez. This is a great quote. I have to read it. A large, right, just not a little bit, a large body of empirical research offers mixed, right, mixed evidence, not conclusive, mixed evidence at best for substantial interest rate effects on investment, right? So they're saying it's mixed at best, and they don't find substantial interest rate effects on investment. Research find that most firms claim that investment plans to be quite insensitive to decreases in interest rates and only somewhat more responsive to interest rate increases, right? And we see it right now. We have interest rates at the lower bound, and investment is not responding, which means that monetary policy at such low rates is like pushing on a string, right? The string won't move, just contortion. Or you can bring a horse to water, but you can't force it to drink. Use whatever expression you want, but investment doesn't respond to low rates, and we know that at least since Keynes, but not for liquidity trap reasons, simply because investments just doesn't respond to interest rates that much. It's insensitive, especially at low rates, and in this quote, asymmetric. And I would agree with that. You push your interest rates high enough, you're going to get your collapse in investment. And this is a quote by Krugman, where he calls this interest inelasticity a dirty little secret of monetary analysis, right? Now, he does say that it might have an effect on real estate market, and that's probably true. But at the end of the quote, he says, any direct effect on business investment following changes in the rate of interest is so small that it's hard even to see it in the data. What drives investment is instead perceptions about market demand. That could have been written by Keynes, by the way, right? Perceptions is simply expectations about market demand. And I would say that investment depends on whether these expectations of the growth of aggregate demand are temporary or permanent. But that's a completely different discussion for another day. So it seems that the IS curve is non-existent. What about the Phillips curve? Well, we know that the Phillips curve has collapsed in the last 30 years. we know that it has a very large segment which is completely inelastic or horizontal, which means that a given inflation rate is associated with any number of unemployment rates. So that relationship is no longer unique. And in this case, policymakers don't have that famous trade-off anymore, that you can push in unemployment closer to full employment without triggering necessarily inflation, unless you're close to the inflation barrier. But there's a very large segment of the Phillips curve that is no longer responsive to that negative relationship between inflation and unemployment. And Claudio Borio of the Biz has said it very well. The response of inflation to a measure of labor market slack has tended to decline and become statistically indistinguishable from zero, right? This is your slope equal to zero. That's your horizontal component of the curve. That is a very strong statement coming from the mainstream. And this quote by Orestes and Sawyer I like. It is a long and uncertain chain of events from an adjustment in the interest rate controlled by the central bank to a desired change in the rate of inflation. Great quote. And other quotes as well. Bob Solow, the Nobel laureate, in the paper I published in the Review of Keynesian Economics in 2018, the slope of the Phillips curve itself. And if you can pick that article up, it is great. It is great. It's written, wonderfully written. The slope of the Phillips curve itself has been getting flatter ever since the 1980s and is now quite small. There is no well-defined natural rate of unemployment, either statistically or conceptually. Strong statements. And that issue in which the paper is a special issue I published for the 50th anniversary of Friedman's presidential address in 1968. There's some great papers in there. I have a paper in there. So does Bob Gordon, and a few others. So it's worth checking out. And so there you go. Speaking of Bob Gordon, the slope of the short-run unemployment relationship has flattened. He even says, is there even still a Phillips curve? Now, the mainstream, many people in the mainstream has responded to that by claiming that the Phillips curve is still there. They just haven't been able to identify it. So what if you include the real estate market? What if you include this or that variable? Can we, in a way, reconstruct the Phillips curve? Because the consequences are dire. If you don't have a Phillips curve, if you don't have an IS curve, your monetary policy becomes useless in terms of an inflation target. You no longer have those transmission mechanisms. And the next slide, I have a couple of quotes, but I just want to say this. So if the Phillips curve has collapsed, this might point to, a different explanation of inflation. Is inflation still demand determined, or is it caused by conflict between labor and private sector firms, right? So should we be talking about conflict inflation rather than a demand inflation? Now, with respect to Phillips curve and IS curve, well, here's a quote. Without the Phillips curve, the whole complicated paraphernalia, and this is Lawrence Summers and Blanchard, the whole complicated paraphernalia that underpins central bank policy suddenly looks very shaky. For this reason, the Phillips curve will not be abandoned likely by policymakers. And this is why they're trying to identify it. And in that same Peterson Institute meeting a few years ago, there's a great quote that I didn't put, but it's in essence, it's like, if you don't have a Phillips curve and a inflation and a IS curve, you're essentially the captain of the Titanic in total darkness. Sorry, you're on the Titanic in total darkness without a captain. So, you know, what is monetary policy? What does it do? So, I'm going to quickly skip over because it's getting late. I'm going to quickly skip over. Well, just have a few, not discuss as much during COVID, the policy, the monetary policy during COVID. Of course, we're set in a framework of secular stagnation, which is a long-term situation of low growth as a result of a collapse of aggregate demand. So I think this is the best way to describe, from a heterodox perspective, a secular stagnation. So it's just basically, we're going to have low growth for the next 10, 15 years, which means under current monetary thinking, if nothing changes, low interest rates for the next 10 to 15 years. And so during COVID, central banks around the world were very quick to lower interest rates. March 27th in Canada, we lowered from 0.75 to 0.25. March 16th in the U.S., we lowered by 50 basis points, which is rare. Usually it's just 25. March 16th in the United States, now interest rates are hovering close to zero. Of course, the federal funds rate. And this is not an unusual reaction. We see this in crises, not close to zero, but certainly lowering of interest rates is part of central bank policy. And that's been accompanied by a very mass purchase of government bonds on the primary and on the secondary markets, and also private sector equity. And with respect to bonds, Canada has almost tripled. The Central Bank of Canada has almost tripled its holdings of Canada bonds, which raises the question of, are central banks really independent? And I'm not saying that's a good thing or a bad thing. I mean, I don't believe in central bank independence for reasons I'll explain later. But the illusion that central banks are independent are absolutely not true. They are a functioning arm of the Treasury. To what degree? Probably not prepared to go as far as the MMT crowd, but certainly there is a there's an active cooperation there. And this is just to show you what's been happening during COVID. This is a graph from a forthcoming paper of mine with Mario Sequereccia. And, what you have here in red and blue is for Canada and the green and black for the United States is this discrepancy between real gross domestic income and disposable income. And this, that reflects essentially how the marginal propensity to save has increased to close to 30% in Canada from a historic level of about 3 or 4%, maybe a little bit more, 5%. But in Canada, Canadians have saved over $150 billion, which is the equivalent of $1.5 trillion in US terms, because our economy is about 10 times smaller. That's an enormous amount of money that Canadians are keeping from the real economy. And in a way, you can see that the lowering of interest rates was aimed at spurring that consumption, sort of teasing that savings out of the private household portfolios. And in the United States, the same thing, but you have this kink in the United States. And I've been wondering what that kink is. And what I think it is COVID fatigue. Americans, more than Canadians, have given up on COVID a long time ago. and have basically said, fuck it, sorry. We're going to go to restaurants now. We're going to go back to restaurants. We're going to go back to bars. We're going to go back to, living our lives. And I think this is what you essentially see here. Initially, there was an increase in savings rate, and not so much anymore. But there's been some implications with monetary policy during COVID, and we see the same thing during the financial crisis. This massive amount of equity buying and bond buying has led to asset inflation, a spectacular rebound of financial markets. And in fact, financial markets have certainly back and even better than the pre-COVID days. And which means there's been an incredible increase in private sector wealth. And what we see now is, if you don't know the author Hilferding, he wrote a wonderful book in the turn of the century, early 20th century, I think it's 1910, where he speaks about this dual economy, and we see it here. I was at UNAM, Mexico, about 10 years ago, after the financial crisis, and I was talking about the rise of the dual economy, what I call the profit and a wage economy. And boy, do you see it here now. You have an incredible, resilient profit economy, financial markets outperforming itself, versus a wage economy where wages are stagnant, declined, and the only question is whether this dual economy is sustainable. No offense to my friends in developing countries. Good morning, Sunanda, by the way, if you're still on, who's in India. And but this is a characteristic of developing economies. So this is worrisome. How far can you go before the working class fights back? Okay, so for example, this is the performance of the Dow Jones, and you notice that it has quadrupled since the financial market collapse after the financial crisis to here. And with respect to COVID, it has gained 50% of its value, of its wealth, since March. And that is, you cannot say the same about wages. So if you reject the new consensus models and the model during COVID, what's left? Well, this is where I want to get into. And unfortunately, I'm just going to have to skip through and not super developed points. I could have spoken for another hour, I'm sure, but then you would have been completely bored. One of the characteristics of post-Keynesians is a belief in endogenous money. And what is meant by this is an exogenous interest rates, or a administered price policy where the rate of interest is controlled by the central bank. And Keynes tells us in 1946, the central bank can have any interest rate it wants. And I think that's very true. And we see it. The Federal Reserve has a zero interest rate. It can have interest rates of 10% tomorrow. It does not mean there won't be any consequences. That's a different story. But it can have any interest rate it wants. I believe that. Monetary base, who cares? No one talks about it anymore except monetarist remnants of a past era. But, you know, the monetary base has increased tenfold, 20-fold since the financial crisis, has had no impact on inflation. And so that's because the monetary base is simply a passive variable that accommodates to economic activity. There's a rejection of the natural rate of interest. That's why I don't think Wiesel has a theory of endogenous money. That's why I don't think the Bank of England paper has endogenous money. Banks are never constrained except by the demand from credit-worthy customers. So it's not a money multiplier model. And that has consequences for monetary policy. Okay, there's no such thing as credit rationing. And of course, the endogenous money view goes back to John Robinson, to the Ratcliffe Commission a little bit, but definitely Kaldor, of course, Basil. I gave a paper on the economics of Basil Moore last week or 10 days ago. And it does carry implications for the transmission mechanisms, because you don't have this money multiplier model. Even if central banks pump liquidity into the banking system, it's not going to lead to increased lending, right? This is one of the two reasons behind quantitative easing. The one was to lower long-term rates as to encourage investment, but we know that doesn't impact. And the other one was to increase liquidity to the banking system in an effort for them to increase lending. Well, we know that doesn't work either. Banks are independent of reserves, or as they are now called, I'm sorry, the word is missing. But anyways, so banks are independent of settlement balances. There you go, of settlement balances. So it does carry important consequences. So if the transmission mechanism is not through, you know, a quantity or a price, what is the transmission mechanism? Well, I think that essentially we have to see interest rates as being not a cost of borrowing, because we know that interest and sensitivity is rather low, but we have to see it as an income. It's an income for bondholders, such that if so, the interest rate itself is an income distributive variable, and this is what the set of papers I wrote with Mark Setterfield, where I developed the Kansas City rule and the Smithen rule and the Pazzinetti rule. This is what it was all about. It was the interest rate, how increases in interest rates raises the rent on bonds to the bondholding class. That's why John Smithen has called that the revenge of the rentier. And I think that this is how you should see monetary policy, that it works through income distribution, through a direct mechanism, which is, you know, increases in interest rates increase the rent on bonds, the interest rate on bonds, and as well feeds asset inflation, which increases the wealth of bondholders and of rentiers. And there's an indirect, and I'm sorry here, I apologize, I put asset inflation in the indirect, it should be in the direct mechanism, but the indirect is through labor markets. If you raise interest rates high enough or sufficiently enough, what you're going to have is you're going to have a collapse of aggregate demand, an increase in labor market, and some impact on the wage share. So does that mean that monetary policy is class biased? Do we have a policy that directly affects a segment of the population, a social class, workers, and benefits another class, rentiers. And if that's the case, what does it say about a so-called independent institution with unelected officials having long-lasting impacts, distributive impacts on a social class? Is that consistent with democratic values? And so that's a question that needs to be addressed, and we'll be coming out with a book on that question. And so, I've done some empirical work on what's called the Pazinetti Index, which was constructed by Lavoie and Seccareccia, and I've applied to a various number of countries. And every country shows the same thing: a transfer of income from a monetary policy perspective between rentiers and workers. And then this is a quote from Lavoie from a paper in a book called Money in Motion. I just want to read it real fast. Please allow me. It then becomes clear that because of the deconstruction that I did in the previous part of the paper, of the presentation, it then becomes clear that monetary policy should not so much be designed to control the level of activity, but rather to find the level of interest rates that will be proper for the economy from a distribution point of view. The aim of such a policy should be to minimize conflict over the income shares in the hope of simultaneously keeping inflation low and activity high. And so those who know me know that Lavoie is my mentor, and I was a student of his some 35 years ago. And like Gretchen has mentioned, I've just edited 2 books in his honor. And so there's a redistribution channel that needs to be discussed. And the mainstream has sort of touched on this, but in a very different way. They do admit, and I've got tons of quotes from the ECB governor and vice governor and different central banks, where they argue there are always income distributive consequences to monetary policy, which is what we say, post-Keynesian say. But the difference is that the mainstream claim that these effects are short-term, that they don't last very long, they're arbitrary, they are, quote, a side effect of good, responsible monetary policy. And since they are a side effect, since they are temporary in nature, they can be completely ignored while setting interest rates. Whereas from the post-Keynesian perspective, well, these effects may not be short-term, they may be long-lasting. And this is something, and we see it. We see just from the growth in private sector equity in financial markets, you see that these effects are very, at least for now, medium term, right? Since 2008, stock markets have increased almost 5%. That's not short term by any measure. And I'm just going to skip this. And I'm going to go straight into, and then that raises the question of whether monetary policy should be seen as an incomes policy for the labor class, and so why is inflation still hovering around 2%? Well, I think that what happens is monetary policy now is seen as some sort of threat, right? If workers demand more than 2% in wage increases, then firms may have to increase prices, right, depending on the relative conflict. But if prices end up going up more than 2%, well, you know what? Central banks will be raising interest rates, and that might end up having a negative impact on labor markets. So I think that from the political economy perspective, this is sort of my view of monetary policy. And I think that that's why inflation has been relatively tame, is because workers have not been demanding high wages, and especially in light of declining unionization rates. Okay. So finally, last two slides, quickly, is monetary policy gender biased? Who owns that wealth, right? And they're mainly white men. I read just recently a study that showed that something like 90% of people who own private sector equity are white men. And that speaks a lot. So when you've had that enormous increase in wealth in the last 12 years, that went largely to white men. And we know that the owner of Tesla has increased his wealth by $100 billion in the last 6 months. And so has Bezos and Bill Gates, and so the trio of Musk, Gates, and Bezos represents, I think, a good sample of what's out there in terms of wealth, and also if interest rates do end up impacting labor markets, which sectors are impacted most? Are these sectors more gender dominant? So do women suffer more than men? And so these are questions, again, Stephanie Seguino, Heinz, they've worked on these questions, and we're coming out with a book on that as well. And another aspect is, does it matter whether you have women working in central banks? Do women bring something different? Does it affect monetary policy or its implementation? And I'm not convinced of this aspect. I mean, you can easily have very progressive white men. You can have very progressive racial minorities. You can have very progressive women, but you can have a bunch of Margaret Thatchers as well. And so, if Margaret Thatcher had been governor of the central bank in England, we can probably all imagine what monetary policy would have looked like in the early 80s. So, but there are some papers, my co-author Guillaume Vallet and a couple of other papers have done work on heterogeneity in the internal composition of central bank committees, etc. And then finally, and I'm going to end with this slide, is monetary policy carbon biased? Now, we know that quantitative easing is the purchase of a lot of private sector equity. Has this purchase benefited carbon intensive industries? Can you design quantitative easing that does not, or that buys equity only from green sectors? Does that make a difference? Do changes in interest rates impede the transition to a lower carbon economy or to low carbon investments? So these are certainly questions that need to be looked at. And yes, I have a book coming out on that as well. So I think that's the end of the presentation. Thank you very much. And I hope that wherever you are in the world, you are keeping safe, and above all, you are wearing a mask. And I just put in an order. I'm buying this mask of Kane's, which I think is completely appropriate. Thank you very much. That's the end of my presentation.
Okay, thank you very much, Louis-Philippe, for your fascinating talk, and I open now the discussion here. So I will collect questions from you, from my students, from all of the people that are with us today. So you can write in the chat or you can raise your hand. I see that Ilan has a question. So Louis-Philippe, would you like to have one by one or collect some of the questions?
Just one by one is fine. And I'm
All
sorry
right.
that Elon has a question.
Okay, so Ilan, you can unmute yourself and ask your question.
Yeah, thank you so much for your presentation, Louis-Philippe. I have two questions. First, somewhere you argued that the household consumption expenditures are also not so much incentive to interest rates. Did I get it right or?
Yes, yes. That's what the empirics seem to point out, that they're not very sensitive.
Yeah, but I suspect if it is hot because last year in Turkey, the decrease in interest rates has stimulated the credit demand of households and not of firms, as also argued by Graziani, if I am spelling right, the Italian monetary securities theorist. And the households raised their consumption expenditures by way of these credits, especially, and not expected by mainstream Turkish economists, the firms. And that increased the import goods and also the current account deficit in Turkey. And I think maybe here we need to decompose the households. The low income groups may have some intensive to the decrease in interest, and also the firms. The small enterprises has a higher incentive to interest rate changes than big firms, because the share of financing of big firms does not rely on so much on credits rather than their own corporate bonds and so on. Fazarani has also an article about that and shows that the different shares of financings items. Secondly, I'm a bit puzzled about the Phillips curves, your disputation to Phillips curves. The Phillips curve has flattened just because of that production in developed countries has become less labor intensive and more capital intensive. That's why the labor has lost its bargaining power, and labor is not so much a cost with compared to capital intensive production, and that's why and also the trade union organization has declined. That's why the bargaining power has declined. And if it is so, a disputation of Phillips curves from a point of post-Keynesianism, isn't it inconsistent with conflictive wage claims explanation of inflation?
Okay.
That's what.
Yeah.
Thank you.
Yeah. Thank you. So I thank you for your questions. I don't necessarily disagree with you. First of all, I think that we usually talk about the aggregate effects, right? So the disaggregate, whether small household or small firms, of course, these are always welcome empirical research. But I think it's true that overall the IS curve has lost a lot of its impact. And it might be because of what you said, that production has become more capital intensive, especially in developed economies. And that's a good observation, and I'm going to have to think about that. And I think you're right about the way the conflict inflation. I think that it is probably less so because of the decrease in unionization that you mentioned. But um, I don't think it weakens the conflict claim. I think it just solidifies it, because inflation has not been a problem for the last 30 years. Why? Well, because if you operate through a conflict inflation claim model, you notice that the relative strength of workers has declined. And so there has not been as much conflict. And therefore, that explains why inflation is more or less under control. And so I think that it strengthens that model. I want to, so thank you for that question.
Yeah, and I received one question in the chat from Ivo Augustinsky. So just let me read it out loud. So Ivo asked if low interest rates lead to inflation of financial instruments. Does it influence also working class through pension funds and mortgages?
Yes. So let me share my file again, my slide again, because I think I went a little bit fast. There was a slide on here where here you go. And so I don't mention pension funds here, but what I do mention, well, yeah, I mean, I think that one of the big problems has been pension funds and hedge funds that have stimulated the growth. And this is something that we should look at. And here I talk about the need to control asset inflation. Now, for your information, the Monetary Policy Project, we're going to have a project precisely on that. I'm publishing a paper by my co-author Sergio Rossi, who's looked at monetary policy and in asset inflation and what we should do in order to control that. And one of the things, we need to be able to have a say in the participation of pension funds and other such institutions. And what we need in the end, here I say we need a proper macroprudential regulatory framework, and we need credit controls, especially credit that's used in order to speculate as opposed to putting it into the industrial circulation. We might have to consider financial transaction tax. And the point is, I don't think that interest rates alone, or low interest rates, or zero interest rates, are to blame for asset inflation. I think that the real culprit is the lack of regulation, because I believe in a permanent low. I don't believe in fine tuning, what I call this activist rule. I believe in what I call the parking it view, or what Lavoie has renamed the income distributive rule. Put interest rates low at, let's say, 1%, and then just leave it there. And then have the necessary transaction tax, credit controls, or other sort of regulatory framework to prevent markets from going completely crazy. I want to answer a quick question from Mohammed, who says, wouldn't decreasing interest rates create a liquidity trap? Mohammed, there is no liquidity trap. It doesn't exist. So liquidity trap thinking, whether that was in Keynes or not, is open to discussion. But the idea of a Hicksian sort of liquidity trap is based on this idea of an exogenous money supply. And so if money is endogenous, you get rid of the liquidity trap completely. Now, if you mean by liquidity trap an unresponsive economy to low interest rates, sure, I'm fine with that. I will share my slides. The video will be on YouTube, so you'll be able to see the video there, and of course the slideshow will be there as well. Professor Rochon is working on a book on monetary policy in developing countries. Yes, given that supply side shocks are a prominent reason for inflation. Okay. Yes. Yes. Well, yeah, so we haven't quite started working on that book. That's going to come next year. And I don't know who you are, Deepak, but if you are a faculty member, send me an email. There's going to be room in that book for people if you're interested. And these are questions that will definitely be on the agenda for that book. Oh, there's quite a few questions as well.
Yeah, we have some more questions from the audience. So Vadim, I guess you were first to raise your hand. So you can unmute yourself and ask your question, please.
Okay, thank you for such presentation, interesting presentation with some revealed orthodoxical points of views. My name is Vadim, I'm a banking expert from Ukraine, and I'd like to ask you two questions. First, these digital currencies of the central banks. In the latest piece of Economist, it was revealed some strange, not strange, argumentical, but solid opinion that such kind of digital currencies, central banks, eradicate the function of bank foundation. In what way? The highest level of the digital currencies in the deposit rate, such currencies may be withdrawn every time at every moment, and then the bank can't manage the gaps between assets and liabilities, and the function of financial intermediary is destroyed. So they also proposed some interesting ways to resolve such problem, and including narrow banking constant, for example. And what is your opinion on such way? And then, if you may, I'll ask you the second question. Okay?
Thank you. I didn't read the Economist article. I'll look for it. But my view on digital currency is that it doesn't change the fundamentals of post-Keynesian endogenous money. I think whether money is digital or not changes very little. What it does change, I think, is probably the implementation of monetary policy. Different instruments used to make sure interest rates converge to target, etc. This is something that might be different, that we need to study, but I don't think it changes. So if you say that it completely destroys the bank intermediary model, well, that's already been destroyed by endogenous money. So I think that it doesn't do much. It doesn't bring anything different, I think, to the table, except for in terms of implementation.
Mm-hmm. Okay, if you don't mind, I may send in some common chat this article and we may discuss the further. Okay, the second question is based on my own experience and job experience in banking regulation and supervision. Please mention the effects of ineffective banking regulation and supervision. First of all, the health of banks' balance sheet. They may distort the monetary transmission mechanism. For example, huge rates of NPLs, non-performing loans, on the bank's balance, and some cases of fraud or resulting in assets concealment. I think that it would be better if you mention this situation, cases, possibilities during your research.
Yeah, thank you very much. Absolutely. I mean, there's going to be losers and winners and losers, but there are winners and losers now under the current system. And
Sure.
yeah, and so, the people who have mostly lost has been workers and, firm, private sector. They have benefited from monetary policy for a very long time. And if you bring in some sort of regulations, etc., yeah, there might be a period of distortions, but I think the overall objective is a good one. And the aim is to sort of limit the gross inequality of wealth. And, if some private sector agents suffer a little bit, of course, but the whole purpose of regulations is to, hurt certain, of course, it's to hurt, it's to limit, it's to curtail. And of course, yes, they're going to suffer, absolutely, but that doesn't bother me at all.
Okay, so maybe we can turn to the next question. So Mehmet, I think you were the second one. So
yes, yeah, I also raised the hands. Well, it's going to be a comment first, and then I will ask question what Louis-Philippe thinks. So if we consider central banks in 2008 and 2020, with respect to the quantitative easing, these central banks purchased private assets from commercial banks and selling them treasury bills in exchange, thus swapping doubtful assets for highly credible ones, those treasury bills. So the reason is that in this strange post-crisis world, banks, the commercial banks, now prefer to collateralized lending, even to each other. So there is a crucial transition from the unsecured interbank money market to the collateralized repo market. So due to this shift, collateral supply right now has become an important factor in money market dynamics, and I believe that there is clear implications for monetary policy. Why? Because after a while, if you think about 2008 and 2020 with respect to the COVID-19, due to unusual size of these operations, I'm talking about these credit easings, these central banks started to run out of treasury bills. What happened after this? They were forced to ask Treasury to issue new government securities, even with this government was not running any deficit. So thus increasing the gross public debt without modifying its net amount. My conclusion is that I believe this shift from unsecured interbank market to repo-based interbank market has important implications for these government debt issues and central bank monetary policy transmission. One result has been to force the central bank to shift its locus, the liquidity from the short-term market to the long-term market. So my question is that, what is the nature of monetary policy implementation in an environment where the core money market operates on a secured collateralized basis?
Yeah. Thank you. Now, when did you say some central banks ran out of treasuries after the financial crisis? Not during COVID.
Not during COVID. That's correct. 2008.
Because they've been flushed with those assets. So I'm not exactly sure in terms of. So for me, it changes nothing in terms of monetary policy. They might have repercussions, like you said, in terms of implementation. And this is something that is different than monetary policy. I think that central banks can have any interest rate it wants, but how it keeps interest rates on target is about implementation. And you're right, this is something that we need to look at. One of the projects that we'll be doing with the monetary policy project is precisely on that question. So send me an email and we can talk about you joining that project as well, because I think that's a very important question. And the way that that project will be run, I think, is we're going to do a series of country analyses. So we're aiming to have, you know, Canada, US, Brazil, ECB, China, India, maybe a country or two in Africa. And the question is, you know, how do these differ in terms of implementation? So very good question. And I think you're absolutely right. And it's something that we need to study. I haven't studied it completely yet, but this is something we'll be start doing soon.
Okay, so now for the sake of time, I will just say that we have like more, we have like 13 minutes more of this lecture. So I see three other questions. So Michał, you can unmute yourself and ask your question.
Okay, thank you, and thank you for the presentation. My question is with regard to the way that that interest rates affect the general economy. So from a perspective of a consumer, the relation between central banking and the private banking sector, and then the loans that are loaned out to the private sector, is built in such a way that usually a central bank's change in interest rates is general and semi-retroactive, as in if you've taken out a loan with a floating interest rates, and most consumers do so, a change in interest rates by the central banks means that not only are you disincentivized from taking out new loans, but also the cost of your current loan increases. And long story short, it can cause the economy to collapse with the amount of costs. So wouldn't it make more sense to create such a system that only affects new loans, so that you incentivize the propensity to save? Even let's look with sympathy, with some amount of sympathy at the current system, but without increasing the cost of current ongoing investments. So in other words, shouldn't interest rates be tailor-made for different social strata and for different time periods of investments, and not affect the whole economy at once, including past loans that were taken out?
Thank you. Sure. I mean, but that's one of the difficulties of monetary policy, because, as I mentioned, it is a blunt instrument. And you've just described in what way it is. You know, you have one price for, you know, different geographic regions within a country like Canada, very different industrial compositions in the East Coast, the West Coast, and the prairies, where it's a lot of agriculture. And so, yeah, I mean, but the problem is you're going to have multiple interest rates, and yeah, increased interest rates affect current loans. You know, that's what you call the balance sheet effects. You know, but then it becomes, you know, I mean, ideally perhaps, but it becomes very difficult. How do you do that with one interest rate? And then how do you prevent arbitrage if that occurs between sectors, regions, between, etc. So I don't know what the answer is, but it's a good question. I think it's more difficult to answer. I want to quickly answer Patricia, who asks, do interest rate changes set by central banks translate into interest rate changes in the real economy? So I'm not sure if I understand it, but the interest rate set by the central bank tends to have an influence on other interest rates on the spectrum, especially on the shorter end of the spectrum. And then even on the longer run on the spectrum. You know, I mentioned how central banks can have any interest rates it wants. I think it can have any short run and any long run rates it wants. And we've seen this with quantitative easing. Okay, thank you. Next question, I guess, by
Najib. Yeah, Najib, your question, and then we have a question from Asgil. So, and that after those two questions, I think we will conclude. Yeah, we'll finish the seminar. So, Najib, please, your question.
Well, thank you so much for a very, very super presentation. I want to thank all the organizers. I want to thank Louis-Philippe, as always. Thank you so much.
Well, thank you, Najib. Nice to see you again.
You are a blessing. You are a blessing for post-Keynesian, Louis-Philippe. I know, look, I love Mark. I love Mario. But we need someone like you actively involved in this social media war against mainstream. So you are a blessing. Thank you.
You know, Mark and Mario tried to hire me at the University of Ottawa years ago. They tried many times because they wanted me to go there to not only do the research with them, but because I organize these conferences and I organize these things. And it would have been incredible, right? The three of us together, but the university just didn't.
Okay.
You know how.
So,
anyway, what's your question? Thank you.
My question is about the dual mandate debate. I know we don't like single mandate, and we, as you know, we filed a petition about 30 economists when it came to Bank of Canada's renewal of mandate. I was one of the signatories.
Yeah.
What is your I don't know. And the reason I'm asking this question is that I ran some regressions on OECD data for 30 years. And I see that according to my findings, which I'll share with you later, it seems that single mandate, although it's single mandate, but it seems to be performing much better than dual or multiple mandates. So what is our stance, our post-Keynesian stance on dual mandate? If we are asked about, okay, what should we target? Let's forget about inflation, but what should we target? Unemployment, output, what else?
Nothing.
Thank you.
Nothing. The reason I say that is because there are post-Keynesians who believe we should target unemployment, we should target growth, we should target some sort of green index, we should target capacity utilization, etc. And those papers are out there. But when I wrote my papers with Mark Setterfield, which is based on a presentation I had given in Dijon, maybe around 2002, my initial reason of writing those papers is because I wanted to find the post-Keynesian reply to Taylor. If not Taylor, then what? Right? If we don't target inflation, what should we target? And that was my initial sort of impetus for developing those papers. And then I started reading and I started reflecting and reading and reflecting. And then I came to the conclusion that central bank is not very good in targeting real variables. It's not, for reasons that I mentioned. And so for that reason, I know that Mario is a fan of a dual mandate, but I'm a fan of dual mandates as a second best solution only. I mean, fine. So what a dual mandate does is, well, first of all, in most Taylor rules, you do have a dual mandate. You have your inflation gap and you have your unemployment gap. So there's a dual mandate right there. My objection to a dual mandate is that I just don't think monetary policy is that effective. And second of all, right, so there. But it's still fine tuning. Right, it's still the fine tuning. Oh, unemployment is lower. Let's lower interest rates and Unemployment is higher. Let's lower interest rates and bring down unemployment. But for me, it falls under the same criticism as the blunt tool. Now, the only reason I would favor a dual mandate is that it would prevent central banks from beginning to raise interest rates too soon. And that's what Jerome Powell has come out with in the United States, some sort of a flexible inflation targeting regime. We're going to let inflation go up a little bit above target before we start raising interest rates. So that's kind of a dual mandate. It's inflation plus some sort of other variable. So I'm not a big fan of dual mandates. I'm not a big fan of mandates because they all rest on fine tuning. And for me, interest rate is about income distribution. So you should, if you read my papers with Mark Setterfield, you should leave interest rates alone and use fiscal policy. And I haven't mentioned fiscal policy, but you should use fiscal policy to do the fine tuning. You know, that's where it's effective. And to answer the previous question, then you can have fiscal policy tailored to regions, tailored to different social classes, different. Fiscal policy is very, very, very flexible. And you should not be using monetary policy for that. Just leave it alone. Set it at 1%, leave it around the Passanelli index. Leave real interest rates alone to the growth rate of labor productivity. Leave it alone. And then use fiscal policy to have an impact on labor markets and etc.
Okay, so now the last question in our meeting. So Asgiel, you can unmute yourself and ask your question.
Thank you. It's already been touched upon. So hello from Iceland. I'm actually sitting in the Fiscal Council. So thank you for the last point on the last comment. But I'm trying to rephrase my question because I wanted to hear more about the unemployment and specifically in these well-off countries like the Scandinavian or the Nordic countries where I'm based and working. You have the lowering of interest rate affecting the part of homes that have mortgages, you know. So I wanted you to turn the income distribution point towards the unemployment thing, but you more or less did it with the fiscal point in the end. So
yeah, and you know, I mean, the purpose of the talk was the future of central banking. But yeah, I mean, I could give a talk on fiscal policy, and in that sense, I believe in a full employment policy. And there's no reason, you know, I think that full employment is not an economic problem; it's a political problem, and that goes back to Kiletsky's very good paper on the political economy of full employment. There's no reason not to have full employment. And just to mention about fiscal policy, the idea that we cannot have certain policies because we can't afford them is absolutely ridiculous. Amidst the COVID, we have seen with deficits at 10, 15 times the size of what they were 8 months ago. We know that there are no limits to fiscal policy. And should I point out, there's no inflation as a result of fiscal policy deficits. So I think that the only thing standing in the way of full employment is the political will to do it, right? So I wanted to get that out. That's it. Thank you very much, everyone from Iceland and India. And where are you, Najib, now?
Najib, yeah, you can unmute.
Saudi Arabia, Middle East.
Okay. So, yeah. So, no matter where you are in the world, thank you very much for attending. I'm very, very happy to have given this talk. Very appreciative to Gretchen, who, by the way, Gretchen and I and a third a colleague of ours have guest edited the next issue that should be coming out very soon of the Review of Political Economy, which is entirely dedicated to Kiletsky, and we wrote the introduction, and that was based on a conference we virtually had. I think it was one of the first virtual conferences in post-Keynesian economics back in September. And it was a 3-day conference. It was crazy. But
that was a big event. Thank you, Louis-Philippe, for your lecture, for your time, for being with us at such early hour. And thank you to all of you for attending this lecture and for your questions. I hope that you like it. Louis-Philippe, will you share with me the slides? If you do so, I will upload it on the website of the foundation, and we will also upload on YouTube the recording of this lecture. So again, thank you.
Thank you very much, everyone. Have a great week and weekend. Happy holidays.
Yeah.
Thank you.
Bye.
Happy holidays.
Bye.
Bye. Have a nice day.
Bye-bye, you too.
Bye.